Hi everyone, my name is Molly Abdouali and welcome to Let's Go Deep Capital, Investing and Wealth. Today we are having a deep conversation with Luda Beanland, Chartered Tax Advisor and co-founder of Longview Wealth Partners. Hi.
Hi, hello Molly. Thank you very much for arranging it and
Yes,
for organizing this amazing podcast.
Thank you for coming. And are you ready? I have so many questions.
Oh, just about.
Tell me, why January is critical in the UK?
Right, so January is the deadline, to be exact, 31st January is a deadline for self-assessment returns. What self-assessment return is? Self-assessment return is a personal tax declaration, and the majority people have to file this tax return. So therefore everybody you hear everybody's going to be busy, everybody's going to be stressed, and if you phone accountancy practice, the most likely they wouldn't answer your call.
Okay. So by everyone, is it only self-employed people, like how about employees? Do they have to file as well?
It's a very good question. Well, employees don't have to file their tax return if their earnings are less than 150,000. However, if you add up benefit and grants and everything else, they have to file. So normally we would say, well, if you earn more than 100,000, most likely you would probably benefit from filing your tax return. But everyone else, pretty much, if you don't have any other income which is not tax at source, it is unlikely that you would need self-assessment tax return.
Okay, thank you. So HMRC, which is Her Majesty
Revenue and Customs.
Yes, so it's our tax authority in the UK.
Yep.
So it consistently cites poor forward planning is a key cause of tax issues.
Yep.
So why do so many UK founders feel surprised by their tax bill every January?
Yeah. So basically what happens that when you hear deadline 31st January, normally you would think, well, you know, I've got plenty, it's 3rd of January, I have plenty of time, got on if you're like, you think, well, it's January, you know, I got a whole month. So we normally say, okay guys, April come, you know, pass by 5th April, let's start thinking about your self-assessment on some clients. Okay, let's come back in September, then December, and then it comes to January, like for January, we still haven't got any information. And the clients, well, now I'm ready, and it is like 30th January or 31st. And obviously then everybody's working under stress, as you can imagine, because we are trying to get the return filed by the deadline, and especially considering that sometimes HMRC experience technical issues because the high volume of people trying to submit their self-assessment returns. And so we are all stressed, we are all, you know, and we try to do it as quickly as possible. And there wouldn't be much time, as you can imagine, within these 2 days think about your tax planning. All we just want to get the job done. And obviously on the 31st, taxpayer look at their bill and saying, wow, I didn't expect that. Well, we at this point we were saying, well, you know, April month for that. But normally, yeah. So if it happens, it's normally okay. It comes as a shock, but we would work with the client, see whether there is anything else. But we would probably do it past 31st January, well, because we have 12 months to resubmit the return. Obviously, we do it in a good faith that return is correct and everything else, and client has to confirm. We don't just file. But generally, the key to planning is to have plenty of time to think about with the client. We actually have a very good case where we still have that client, amazing client, absolutely wonderful. So they came to us quite late. I would say probably late December. It wasn't 31st January, to be honest, to be fair. So, but it still was quite late. We already had a lot of jobs in stock, and we already were working under pressure. So we filed a return using what it's called, it used to be the remittance basis. And as a result, claiming remittance basis, which was at the time the most beneficial way, client ended up paying tax in the millions. So there was a few millions for tax liability. Later on in the year, we just randomly talking to a client and discussing tax affairs. Turned out to be that It could be if we realize we were to use double tax treaties, actually client wouldn't have been a tax resident altogether, and as a result he wouldn't have to pay anything at all apart from probably a few thousands of pounds on the UK source of income, which was interest at the time. So but these things only would work when you talk to accountant, you have you arrange a proper meeting, you arrange a proper tax advice, you actually have a conversation like we are having now. But without it just sending information across, obviously you're doing a good faith, you are doing, you know, what at the time seemed to be the correct way, but without talking, without knowing exactly, you know, where client's affairs actually exactly are, and where his interests, you know, personal interests, business interests are, it's impossible to actually to do any plan. So we always urge clients, you know, come to us, talk to us, have a few meetings with us, tell us about your life, tell us about your children, your family, you know, where they're all. So it's important for us actually, it's not just sharing and having a chat, it's about actually looking at your family and see, okay, where your interests are, what your other family members are doing, and then doing a tax planning based on this structure.
So when is the best time? Like after April, it's too late to plan for your previous
I think
year, right?
after January. I think the good timing normally, I would say, you know, as soon as possible. I mean, in reality, once you are ready, I mean, obviously in January, if you come to us, we probably would be just too busy. But anytime, I would say anytime but January. So anytime, as soon as you know, you've got, say you've got assets abroad, you've got, there is something even worries you, you want to ask a question, I would urge to do it as soon as possible. So we would have plenty of time to think about it, to arrange and structure our tax affairs in the most tax efficient way.
Thank you. So so let's assume that the founder had a good year, which is good. Like having a high amount of tax, is good. This person had a good year, and they are surprised. But do they have to pay everything before the 31st of January?
When we say everything, so you mean like whole tax liability?
Yes.
Well, normally, the other thing which probably a founder or a businessman who draws, say, dividends or any other income which is not taxed source will be highly surprised, because not only they have to pay the actual tax liability, they also have to prepay 50% of the future tax liability. So, and it's so in addition to the actual bill, they have to pay 50%, and the other 50% they have to pay by 31st July. I think this concept of which is called payment on accounts is not well understood by people, because when they get the actual bill and then they see another 50% on the top of that, it was like, hang on, like why I have to pay and my actual bill and 50%, and then you try to explain, well, you know, because HMRC want you to pay a sort of huge tax liability. But then actually, if you think about it, whether it is fair or not, probably, I mean, I know it's not probably what you would like to hear, it is fair. You know why? Because on the 31st of January, you are paying tax liability for the year which is finished last year in April. So if you think about it, however, you are now in the current year, right, which started on 6th April. So you are actually paying like sort of, okay, it is a bit in advance, but you are just 3 months away from a finishing current year. So in a way, you know, it's not too unfair, I suppose. But it does come as a shock for a businessman.
Can you explain more about payments on accounts? I think this is a very confusing topic for many people.
Well, let's take simple numbers. I'm not going to talk about millions. So say your tax liability is 1,200. Okay, so we've done your tax return and we are telling you to pay 1,200. But then you see, in addition to 1,200, you also have another £600 to pay, and you're wondering, hang on, why I have to pay that? Well, that's because it's 50% of 1,200. Okay, that's 600. So you just have to add that on the top of 1,200, which is 1,800. And then on the 31st January, you have to pay the remainder, £600. However, say next year come, we calculate your tax liability, say 1,500, okay? So that means, 1,500 less your prepayment, which was 1,200, £300, you have to pay extra for your current year, but then you have to pay again 50%, which is £750 of the current tax liability. So it goes on like that every year. You have to pay, then you have to deduct, then you have to calculate another 50%. So it is fun. It is fun. We've got
fun for you.
Yeah, it is fun for me, but not probably for the clients.
Yes, absolutely. So are there any ways to reduce payments on accounts?
There are actually. First of all, we have to have a legitimate reason why you think that your payment on account is, why it should be reduced. So for example, if you say, well, you know what, I don't have much money, can you reduce my payment on account, which we hear actually, well, not too often, but time to time. Or the other reason, well, I don't feel like, obviously it's not a legitimate reason. However, if for example you say, well, last year my dividend was that much, this dividend I'm expecting much less, or I have downfall of my income, so I don't believe that currently, and here is a factual, here is a fact, so my payment, and as a result, my tax liability will be less this year. So then it is a legitimate reason, and we can reduce your payment on accounts as a result.
Oh, how often do you do that?
I wouldn't say it's too often. It's not too often. So I would say on a few occasions, rare occasions,
yes.
but it does happen.
Interest and penalties begin immediately after the deadline. Is that true?
Yes. So if you don't submit your self-assessment return, there will be immediately £100 charge in the penalties, which will grow with the time. Exactly. So it's not something we suggest. However, interesting fact, if for example, if HMRC sends you what's called notice to file, and you don't file, but in reality you shouldn't have filed it in the first place, you thought, because very often when we ask clients, why have you not done anything, they said, well, I thought, because I didn't need to file it, I don't need to do anything. So it's okay. So in this case, we will just cancel notice to file, and the clients normally don't have to pay that penalty if tax return was not due in any case.
But if it was due,
then it is £100, which still
plus interest
yes,
for every
exactly,
day.
and then these penalties increase. However, if you had a genuine reason why you have not submitted, not because you want,
I forgot.
So you still can cancel the penalties. You can appeal against penalties. You can't appeal against interest. That's interesting thing, but you can appeal against if you have a reason why.
So what happens if the UK director says, he genuinely doesn't have money by the 31st of January to pay his taxes? What happens?
So it is an interesting also question because there is a time to file facility which HMRC offers to all taxpayers, not only company directors, for those ones who do not have available cash to pay. So the way it normally works, normally it's not the agent, it's not us call, it would normally be taxpayer, they would have to call HMRC, and I normally say, okay, get prepared because you will be questioned, So normally HMRC asks questions such as, okay, what's your overall income? What's your monthly expenditure? So they will want your breakdown, all your income, all your expenditure. They would also leave you money for something like entertainment, cinema. You will be surprised how nice they can be and considerate, So it's not like you will have to live tight. So then after the breakdown, they would figure out what the difference between your income and expenditure, and whether you are able to afford the sum of the money which you are telling them you're going to pay monthly. So so it's much better way rather than just not to pay at all, because there would be penalties and interest. I mean, in this, if you arrange time to pay, yes, there would be some interest. I mean, yeah, HMRC at the time going rate, but it's much better than you arrange something with HMRC, how you're going to pay. Normally it's a management amount of money. They would normally also ask you how much can you pay now, because that's one of the questions. So if you think you can just get away without paying anything, that's very unlikely. They will ask you, well, how much you are happy to make payment. So be prepared, you at least pay something like at the time, and maybe on the phone, just to keep HMRC officer happy.
Okay, so according to HMRC, over 70% of small company directors use salary dividend mix.
Yeah.
So what is the most efficient way? I mean, I obviously know, but tell us.
Yeah. Of course, yeah. Well, it still remains. I mean, different advisors got different opinions on that. I mean, in the past, there used to be the salary, anything from 9,000 to 12,570. Well, now in reality, what's your mix is depending on what actually your other income is. So if in the past I would say, well, definitely go for
minimum salary.
Exactly. So probably it's not minimum salary even. It's minimum probably director salary.
Yes.
Like, so that will be maximum to 12,570 a year. But however, now if somebody comes to me, I wouldn't just give them automatically that. I would have a look. Okay, what's your overall income, what's your overall salary, do you have any other people on the payroll, and based on that probably I would suggest. But yeah, the normal mix probably would be around the 12,000 pound salary, and the remainder is dividend. But once again, I would, instead of claiming that one universal
solution,
exactly,
yes.
So solution fits for every family, in reality it depends. For example, let me give you an example. If somebody has got a job elsewhere, or if they already have say self-employment income, or if they've got untaxed income abroad already, which utilizing that basic allowance, that's probably not something I would advise them to do. I would probably give them salary just covering even around the 8,000 pounds, covering their allowance, just to give them qualifying year for stated probably. Yeah.
So according to HMRC, illegal dividends are a common trigger in HMRC inquiries.
Oh yes.
So why do so many directors accidentally create tax problems with their dividends?
Yeah, that's very good question. In reality, there are lots of court cases where company corporate tax files one thing, but then on a personal tax return, taxpayer files something else. And normally that's the dividend issue. So what is illegal dividend? If we break it down, illegal dividend, it's not because you're taking it illegally, you're stealing something. It sounds like, isn't it? However, it's simple. You don't have enough distributable profits to pay yourself dividend. So what you take from the company, you might call it dividend, but in reality it's a loan. You simply take a loan from a company, provided that actually company does have a cash available, so any money which company director takes and it doesn't entirely up with distributable profits, called illegal dividends. So if somebody takes illegal dividends and they declare, but company doesn't have, say company is making loss, then the question is how, obviously for HMRC, it's two dots don't tally up, and HMRC would open up inquiry. So unfortunately, that's and why it happens. Well, very good question. I think at times probably I believe probably taxpayer has got an accountant, probably the right hand doesn't know what left does because corporate tax and personal tax return. Probably two different departments that they have to talk to each other. Probably they don't. I would imagine.
Yes, or just director needs money and he spends, and then he thinks that's fine. Maybe they have cash on their account and they think that it's fine. We have money. Yeah.
Well, up to a certain point, but then you see you don't declare as a dividend. You just keep it as a loan. There is nothing wrong with a loan. You just have to return it within 9 months, 1 day. But there is nothing wrong with a loan. So I think HMRC opens up inquiry when corporate tax doesn't allow with the personal tax or the director. I would imagine.
Okay. Okay, let's talk about VAT.
Yeah.
So the VAT threshold remains like around 90,000
Exactly.
right now.
Yeah.
Yes,
Yeah.
and late registration often results in backdated VAT bills.
Oh yes. Yes.
So
That's
when
right.
does a business need to register for VAT?
Right. So yep.
And what happens if you register late?
Right. So generally speaking, you would have to. There are 2 tests. I always say one is historic, the other one is future test. So what's historic test? You look back up to 12 months and see whether you exceeded 90,000 threshold. When we are talking about 90,000 threshold, we are talking about taxable supplies. Taxable, that's something you would sell to UK customers mainly. Okay, so mainly there are some exemptions, and we are not going into that. So it has to be UK taxable suppliers. And so historic test, when you look at it, some people thinking, well, I have to wait 12 months, and then if within 12 months my VAT hasn't reached, I'm fine. So the way it works, you look back every month since inception of the business. So you open up 1 month, you have been trading 1 month, you look back 1 month, have I reached that 90,000? But then you wait 2 months, and that's up to 12 months. So it's a rolling basis, and then you reach 13 month, you look back 12 months, and then so that's historic test. Future test, in 1 month on its own, you would have exceed 90,000 pounds turnover. So then the registration is immediate. If you don't register, there would be penalties, interest, and so on and so forth. Now, very often, where it happens that business owner finds out suddenly that actually they should have registered for VAT 12 months ago. Normally, from our observation, clients are in charge for their own bookkeeping, number one. Second thing, actually, they haven't sort of kept up to date with the bookkeeping, so they had even they were aware of 90,000, they just didn't know what their sales were like, and that would result in however, if advisor not normally professionally qualified who would do bookkeeping and VAT, they would probably notice, well, most likely they really have to notice that business owner would have breached 90,000, and normally HMRC gives 1 month for sort of realizing that you have breached that threshold. So there is plenty of time to realize that you have breached that threshold, and it's time to register.
Okay, thank you. So, according to HMRC again, VAT is one of the most common causes of unexpected tax debts for small, medium enterprises. So, why does VAT often create cash flow problems for growing UK businesses?
Yeah.
And how to avoid it?
Yeah. So, it's a very good question. But in reality, if you think about it, what is VAT bill? VAT bill is it's a difference between VAT which you charge and you've been charged, and you pretty much hold that VAT for HMRC on HMRC behalf. And if you think about it, you actually got this difference over 3 months, and then you've got 1 month and 7 days to pay it off to HMRC, right? So the question is, that's actually quite interesting. Well, you kind of hold the difference, say you're not making losses, and you charge your customers VAT. In reality, it's not your money. It feels like your money, but in reality, it's not, unfortunately. So it shouldn't be like that, shouldn't. But then it gives you, when you have quite a lot of cash on your bank account, it gives you false kind of feeling that the money is yours. Then is in reality that part of it belongs to HMRC. And I think after 3 months, if business actually is turning quite a bit, you realize, and then your VAT return is done, you realize, wow, that's massive bill. And because it's over 3 months, there would be quite a lot if you're turning quite a lot of actually cash. And that can have a massive impact on your business if you did not put aside for that VAT during those 3 months. So the way we found how it worked for us, or works for us, is that we do keep up with the bookkeeping. Every month our bookkeeper would have a look, okay, that's your profit and loss, and that's how much money you made that month, and also your VAT bill for that month is this. So instead of having that false feeling like you got so much money on your bank account and you can maybe invest it in the business or personal, you just take it and you put it in the savings account, you just put aside. So when it comes down to in 3 months time, you don't get a shock of your life by high VAT bill, because you actually have been putting money aside for that.
Yes, thank you. So would you recommend, like, I remember we talked about it, and you recommended to have a separate account and put 20% VAT there to keep it separate. And if you have less, like, because you subtract dividend VAT you paid, then you have a nice surprise. You have to pay less than you have money on that VAT.
Well, yes, it is one of the ways how you can sort of save yourself from a shock of your life, you know. So when you get a bill, you say, well, actually I have been, you know, putting aside, so it feels much better, you know.
Again, according to the pensions regulator now, the pensions regulator issues thousands of compliance notices each year. Yes. So why do you think it happens?
For the companies, well, normally the company has an obligation to auto-enroll all their employees and into pension after 3 months of their employment. Okay, so generally speaking, employer is not aware of that, or their accountant is not qualified to advise a company director to enroll their employees, or they fail to pay a bill, or they fail someone to enroll, say they've got a pension scheme already set up, but they fail to enroll. So there are various issues. We had someone who wasn't paying their bill, and then they were trying to set up a direct debit. For some reason they failed, and we had notifications that they were not paying pension bills, so we would send a reminder. However, that reminder was ignored. So as a result, I think the end issue was that the company faced about £60,000 in penalties because they were just ignoring to pay the bill. So there are various reasons why, you will be surprised why, you know, on the different stages, but that's, I would say, unfortunately, penalties are quite common.
So apart from finding a proper accountant like Longview, what would you recommend to do with pensions? So as soon as you hire someone, within 3 months, you have to sign him up for a pension.
Exactly. So I would suggest, once you open up a business and you're thinking of employing someone else, and also for yourself as well, I think I personally have a view that pension savings is a good actually investment, is a good thing. And so I would suggest that the company would set up pension scheme straight away. I mean, fair enough, the company director might enroll into the pension maybe 3 months after employee starts working for the employer, but generally I suggest to set up pension schemes straight away.
What actually triggers HMRC inquiries into UK company directors? What are the most common mistakes?
So I would say common mistakes where corporate tax doesn't match to personal tax return. That's, for example, overdrawn director's loan accounts, where someone say didn't declare a dividend, but they declare dividends in the self-assessment tax return, or vice versa. VAT errors, and the third one is inconsistent income during different years. So for example, last year you had absolutely, say, $500,000, and this year you're declaring 5p. So HMRC would likely, wonder why last year it was 5 million, but this year it was 5p. But so these are probably the most common ones.
Okay, so thank you. Why are director loan accounts such a hidden risk for founders?
Yeah, so what's really overdrawn director's loan account? What's that about? First of all, to understand what's on the balance sheet, there is a nominal ledger called director's loan account. And what's that about? So any monies which director owes to the company and company owes to director is actually kept, and the record keeping is via that nominal ledger. So as you can imagine, all transactions, personal nature, would go through that nominal ledger account on the balance sheet. And where there is an issue when a company director owes to the company, and how would they owe? For example, during a year, instead of, because we normally declare dividends, say, once a year, so instead of drawing dividend or paying a salary, say, we take loan from the company, but then at the end of the year, that loan normally would be converted to a dividend, and that dividend we declare in self-assessment return. But then when we come to the end of the year, and if company hasn't made enough money to declare that dividend, there would be a problem. There would be outstanding loan, and by the legislation, a company director has to return that loan within 9 months, 1 day. And if they don't, then they have to pay additional tax along with the corporate tax. Normally it's 33.75%. And company directors, obviously, they don't want to pay because that's a dividend rate they have to pay. And they don't pay that. And as a result, there is an issue there, which is overdrawn director's loan account, and director doesn't cover it, doesn't return the money to the company. So that's an issue which HMRC are trying to tackle.
Could you please explain us what does it mean to have a proactive accountant and reactive accounting?
Okay, so basically, what is proactive? Proactive is someone who would talk to you during the year, and I would, when you look for an accountant, I always say go for someone who offers you support. And when you see somebody saying 24 hours, 365, support, and it is cheap, I would raise probably my eyebrows. Or if somebody doesn't offer you anything, that's also would probably raise my eyebrows. I would look for probably someone who actually there is somewhere in the fees, meeting ups, maybe once a month or every quarter, where you would meet your accountant, possibly the best face to face, and discuss your affairs, explain where you are, how your business are doing, maybe there is an advice. So that's, if you talk to your accountant, I think there would be more chances that the accountant would offer you something proactive. So make sure when you sign a contract, there is something there which says your quarterly review or monthly review. That's where you will get your advice proactively. And reactive is someone, for example, you come, as we discussed, on the 31st January and with your information for your tax return. Probably that would be the best time to do for the for the tax planning, and you would probably end up paying quite a lot of tax.
Okay. What should UK founders plan in January to avoid problems later in the year?
Well, I always say, okay, start thinking about your tax return for the next year in February. So in January, have a fun, enjoy your life. Come to February and don't call to your accountant because they're probably going to be busy.
Make sure that you file your self-assessment.
After your self-assessment is filed, but start February is the best time. I would say February, because February, March, April, it's a quiet time for self-assessment tax return, and your accountant would have a time of their life, and probably the best time, that's where you can catch up with your accountant and have a coffee and discuss your affairs and how they can help you.
Thank you. So how does proper cash flow forecasting reduce tax stress for founders?
That's a very good one. I always say plan your taxes. So pretty much once you know what your tax bill is going to be, have some cash flow, do your personal planning, what your income, what your expenditure, how much you can put aside for your tax liability. Obviously, once you have that plan, when you know your next time tax liability, you wouldn't have a shock of your life, or come to the deadline, you wouldn't have a stress where trying to look for the money and you haven't got it. So having a cash flow, which basically financial plan, how you're going to save up, or how you're going to put aside something you earn now for the future tax liability, is a good way going forward.
So from your experience, how many years have you been running accountancy firm?
Oh, well, 12 years.
12 years.
Yeah.
So from your experience, how often do the clients struggle to pay their taxes?
Well, sadly, all the time.
Really? Or do they have a separate account? Like, do they manage their cash flow?
Well, generally 50-50. I would say even some clients, we obviously preach, that you're supposed to do this, but in life, sometimes there are emergencies and it's not working out as it should be. And some people, they do know they need to put aside, and they don't. And when it comes to the end of the year, they don't have the money. I mean, okay, so we'll tell them, okay, call HMRC facility, it's time to pay, So and arrange a tax plan, sort of a plan how you can pay. But I would say 50-50, 50% of our clients, to give them credit, actually do put aside.
Yes. So how would you, you mentioned a little bit about that, but what are the best ways to pick a good accountant? What are the red flags in accounting company, let's say?
Yeah.
Red flags first.
Red flags, okay, red flags. I'll tell you something interesting actually. When we just started up the business, and from time to time, we call it secret shopper, which basically, you need to understand what your competitors are doing, but you don't want to use their time much, because you feel quite conscious and unethical, if you spend somebody's time. Yes. But however, I remember still many years ago, we had competitors just across the road in Wimbledon, and one of our employees, she arranged an appointment. It was before COVID times, where you had to see the person face to face. So she comes and she meets an accountant. She say, well, I'm doing some bracelet business, and she said, oh, wonderful, congratulations. So it seemed to be, nice conversation was flowing. However, later on, she asked, what about if I exceed my threshold VAT? And she was told, oh, don't worry about it. She's like, oh no, but don't I need to register for VAT? And she was told, don't worry about it, we'll just open another business. We'll just keep opening the businesses. So each business would never exceed VAT threshold, so you never have to pay. I mean, that is pretty much just one short meeting. That's probably, if you see something like that. The other stories we hear, accountant asking to, on their behalf, is to borrow the money. So we various, so you name it, the things. But if you feel that your prospective accountant is suggesting scheme which sound a bit too good, I would say probably do another research. Do research whether that is legitimate or not. And if something doesn't feel comfortable, that's probably probably your gut feeling would tell you that you're right.
Yes, I would also say too cheap. Yes, if the services are too cheap.
Oh yeah, absolutely, yeah. So we know accountants, their labor doesn't even cover the minimum wage. And here's a two question: how do they make money? First one, they would be based, if it sounds to you too cheap, one of the reasons, they could be based somewhere in India, and they wouldn't be authorized agents as a result, or they wouldn't give any consideration to your tax planning, and you would probably end up paying more in a tax bill rather than saving on accountancy fees. So the second one would be someone who just starting up. They specifically put cheap prices just
to gain clients.
Exactly, to gain clients, and then they're going to increase it later on. So however, it's just a short game that they're playing. So yeah, so there are two things, and I always say the cheap or free of charge cheese is just in the mousetrap, but yeah.
What are the green flags? Like how do you understand that this accounting company is good?
Yeah, so first of all, I would check their website, social media. I would check their credentials, that they've got practicing license. I would check that prices are at least in the middle somewhere. So you don't want too cheap, but you don't want too expensive. So prices somewhere in the middle range. That you like them, you speak to them and you like them, because I think a lot of things you would have to share with your accountant quite a lot. So it's not just 1 5-minute introductory meeting and then they just do compliance. So make sure you feel comfortable about telling them your storyline. That I think that's also is quite important, likability.
And I think I would also add that make sure that they do anti-money laundering check and KYC, right? They do not accept you as a client straight away, but they do some checks because they are required to, right?
Oh yeah, absolutely. But I would imagine anyone with a practicing license would be required to do so. So first thing, I would check had they got the practicing license, and if they do, then it would give me some comfort that they probably going to do all the compliance they required. But you're right, if they don't, I would say, well, they haven't asked me for a copy of my passport, what's wrong with them? That's true.
So what are the warning signs that the founder has outgrown their accounting firm, that they are too big for this accounting firm? Does it happen?
Yes, it does happen actually. We have quite a few clients approaching us and they were looking for a new accountant, and we always ask like, what's wrong with your current accountant? And funnily enough, on a few occasions, we were told that it's normally one person working, and now we have grown our team, our accountant that cannot manage because they're just one-man band and we require something else, or they're so busy they can't answer a question because they got so many clients and there is just one person there. And so I think at that point where initially if you start up, you're looking for something maybe cheap, I would imagine, but then once you started turning and trading and you feel you need a bit more sophisticated advice, I think at that point normally our clients would look, well, they become our clients, they would become our clients. But we tell them when they look for an accountant, we tell them, listen, if you are planning to grow, you need right structure straight away. It will be just faster.
Yeah, I can imagine that initially startups might hire one person who would do everything, but later when it becomes too complicated, they need an accounting company. Like at Longview, how many people work at Longview?
About 30
people, and each of these people, they specialize in pensions, VAT.
Exactly, VAT, bookkeeping, company accounts, personal
and
tax,
they have obviously
tax
deeper
advice.
knowledge.
Exactly, we've got even our own mentoring department, which we hold startups' hands and who require actually advice on a monthly basis, and we meet up them and advise them how cash flows, VATs, and everything else. So they are very well equipped.
Yes, thank you. So last question, could you please tell me more about your ideal founder client? Yes, is this a person who is just starting their business or moving from another country to the UK? So how does it work?
I think probably there are two types of our ideal clients. One is who's starting up the business. We will love, because you got the mentoring department, you got all the structure. We love business owners, and with that we love those ones who do not know anything. So as well, because we love to feel information, and it's absolutely passionately we tell them, what about this, what about that, and when they see them grow, I think that's why we get own satisfactions, like, well, we help them so much. So that's kind of ideal client. Then second type of already they've got established businesses, they're already turning quite a lot of money, they are in a good place, however they want to grow further, and at times they probably struggle sometimes with the cash, and they really need us. They need us to do the tax planning. The most, and they probably pay quite a bit of tax as well. So they need us for the tax planning. If they struggle with the cash, they need us for the cash flow advice and how to properly manage the funds, or just to advise on the structure. For example, it's a family business and they want advice how to do it most tax efficient for their family. So yeah.
Okay. Oh, I'm so sorry, but I have one more question.
Of course.
I know that you also help to register for EIS and SEIS, right?
Oh yes, of course. Yeah. Yeah.
So that's one of the ways for people to reduce their taxes.
Exactly. Yeah.
And for founders to get more
exactly investment. Yeah. So we also we helped a lot those clients who do seek investment to grow business or for different purposes. And in this case, yes, we suggest the schemes such as enterprise investment scheme. That's where your investors would get 30% of their tax bill, either 1 million or 2 million, depending what your business does. So also we advise on research development credits, where you also can, if company is at loss, you can have some money back. If you are in profit, then you will get a tax reducer for your corporate tax bill. So so we absolutely love these types of companies, and depending again what the plans are, if they seek investment, we would definitely advise to register for one of these schemes.
Thank you so much. So subscribe to this channel, and you can find more information about Longview Wealth Partners below the video, the website, the social media, and everything. Leave your comments and ask questions. Maybe next time I will ask them, and the Luda will be happy to answer them.
Absolutely, always. Thank you very much,
Thank
Molly.
you. Subscribe and like and share with your friends.
Thank you.